We're jumping straight into iShares Silver Trust today. Everyone is watching the price action, but the real story is the rapidly shrinking COMEX silver supplies and the building potential for a massive short squeeze.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we really get going, please hit that subscribe and hit the like button. Our entire mission here is to welcome you in, take all this complex financial data, strip away the noise, and, simplify it so you can actually understand what is driving your portfolio.
Right, we basically do the heavy lifting so you don't have to.
Exactly. So let us set the stage with what is happening in the precious metal space right now, specifically with the iShares Silver Trust. If you've been tracking the commodity sectors, the performance profile here is an absolute anomaly.
Oh, it's completely outside the
I
norm.
mean, as of February 26, 2026, we're looking at a 147.86% one-year return. That is the kind of explosive move you usually associate with a hyper-growth tech stock, not a physical metal that has been mined for thousands of years.
And the compounding velocity over the last few quarters is what really stands out in the institutional data. The return for the full year of 2025 was 20.89%.
Which is a great year on its own.
Yeah, but instead of exhausting itself, that momentum accelerated. Right now, just 2 months into the new year, the year-to-date return is already sitting at 19.96%.
Almost 20% in 2 months.
Exactly. The market is witnessing these triple-digit surges, and institutions are actively trying to map whether this is a temporary dislocation or a permanent structural repricing of the asset.
Right.
Let's break that down even further.
Yeah.
Because to understand those returns, you really have to look at the structure of the fund itself. You are looking at a fortress-like balance sheet holding $23.3 billion in total assets.
$23.3 billion.
Right. And the defining characteristic of that $23.3 billion is that it is 100% allocated to physical silver bullion. There is zero debt on the books.
That distinction right there, the difference between physical bullion and paper derivatives is critical here,
Sure.
especially when we talk about the shrinking supplies on the COMEX. It changes everything.
For anyone unfamiliar, the COMEX is the primary global futures and options market for trading metals. It is where the global spot price is largely discovered, but the COMEX operates heavily on leverage.
Heavily.
You have massive amounts of paper contracts trading back and forth, representing claims on silver, but only a fraction of that silver actually sits in the registered vaults, ready for delivery. When you buy the iShares Silver Trust, you are bypassing that entire levered paper system. You have zero counterparty risk because the asset is literally sitting in a vault. And that physical backing functions as the ultimate competitive moat for this specific trust. Most retail investors who want commodity exposure end up buying synthetic ETFs that rely entirely on futures contracts.
Right. Paper exposure.
Yeah. They track the spot price of the metal, look at their brokerage account a year later, and wonder why their returns are lagging behind the actual market price of the commodity. They're getting chewed up by the roll yield.
That structural drag is essentially contango decay, right? Let's get into the mechanics of that because it is the silent killer of commodity portfolios.
It really is. In a normal contango market, the futures contracts expiring further out in time carry a premium. They are more expensive than the near-term contracts.
Right. There's a premium built in for time and storage.
That structural premium is exactly where the decay happens. If a synthetic fund holds front-month futures contracts, they are forced to systematically sell those expiring contracts at a lower price and buy the next month's contracts at a higher price just to maintain their exposure.
It is a mathematical bleed.
Yes. If the spot price of silver stays perfectly flat for 12 months, a futures-based ETF will consistently lose net asset value simply from the mathematical friction of rolling those contracts up the contango curve.
But because the iShares Silver Trust holds the actual physical bars, it entirely circumvents that contango decay. There is no futures curve to navigate. Now, holding physical metal obviously isn't free.
No, you have vaulting, insurance, and audit costs.
Exactly. The trust yields 0.00%. There is no dividend or free cash flow being generated here. But management manages to keep the gross expense ratio at a very lean 0.50%. For a $23.3 billion physical hoard, 50 basis points is a highly efficient way to maintain pure price exposure without that synthetic drag.
And that efficient structure is why we're seeing such aggressive institutional accumulation. The whale tracking metrics, which monitor the flow of large-scale institutional capital, show sustained accumulation in this asset following a prolonged period of deleveraging.
The major players are moving in.
They are building structural positions, and their conviction is largely driven by the underlying industrial usage constraints. Silver is the most conductive metal on the periodic table. As global infrastructure transitions, the demand inelasticity is becoming severe.
The industrial math is really hard to ignore. Photovoltaic capacity, like solar panels, requires massive volumes of silver paste, and the industry has largely hit a technological wall when it comes to thrifting, which is reducing the amount of silver needed per panel.
They simply can't use less without losing efficiency.
Right. Add to that the electric vehicle sector, where an EV requires roughly double the silver of a standard internal combustion vehicle, and you have sustained industrial demand colliding directly with inelastic mining supply.
It is incredibly telling that despite a 147% run-up in price, there have been zero downward analyst revisions recently. The street seems to believe the structural supply deficit is firmly entrenched.
Yeah, with institutional flows locking up the physical supply, inelastic industrial demand, and zero roll yield drag, the thesis sounds almost mathematically bulletproof. But looking at the flip side, the volatility profile of this asset tells a much more violent story.
It does. Commodity exposure always carries inherent risks.
We just saw a sudden 3% pullback in the price action. And if you look at the quantitative sentiment scores across top financial media and institutional desks right now, it is sitting at strictly neutral. The ticker sentiment score is a flat 0.
That flat zero indicates a market that is highly cautious about the altitude we have reached. To understand that caution, just look at the net asset value. The NAV currently sits at $81.51. That is the actual fundamental value of the physical holdings per share.
But the range around that NAV is wild.
Incredibly wide. Over the past year, this asset has swung from a low of $27.46 all the way up to $107.35. A spread like that indicates extreme speculative fervor, driving the price far above and below its historical baseline.
That brings up the fundamental law of financial gravity, which is historical mean reversion. We are analyzing a 144% plus rally over a single year, but the long-term compound annual growth rate, the CAGR for silver, historically sits right around 5.9%.
Right.
We are talking about an asset that traditionally grinds out a 6% annual return suddenly going parabolic.
And whenever an asset deviates that violently from its historical CAGR, the risk of a brutal mean reversion becomes the primary threat to new capital.
It has to snap back eventually.
Well, the market has to resolve whether this 147% move is a permanent paradigm shift driven by those solar and EV supply deficits, or if it is merely a cyclical, speculative bubble that is destined to snap back toward that 5.9% trend line.
And if it is the latter, investors buying at the top of that $107 range are going to experience a punishing drawdown.
There is an even more punishing drawback that retail investors rarely factor into their models, and that is the tax catch.
Right. We need to detail the grantor trust tax structure. Holding the iShares Silver Trust in a standard taxable brokerage account fundamentally alters your net of tax return profile compared to a standard equity ETF.
This is a critical structural trap. When you buy an S&P 500 ETF and hold it for over a year, you benefit from the preferential long-term capital gains rate, which is typically 15% or 20% depending on your income bracket.
But the IRS does not classify the iShares Silver Trust as a standard security.
No. Because the trust is a physical pass-through vehicle, the IRS treats your shares as direct ownership of the underlying bullion. And under the U.S. tax code, physical precious metals are classified as collectibles.
So the IRS taxes this the exact same way they would tax a rare piece of art, a vintage Ferrari, or a graded baseball card.
Precisely. And the long-term capital gains tax rate on collectibles is capped at a maximum of 28%. So if you hold this asset for 5 years, perfectly timing the structural bull market and then sell to realize your gains, you could be handing 28% of that profit directly to the government.
That nearly doubles the standard tax liability. Suddenly, that hyper-efficient 0.50% expense ratio feels entirely irrelevant if your back-end tax bill is eating nearly a third of your total return.
It completely changes the risk-reward math for a multi-year hold.
If an investor is bullish on the physical metal but wants to avoid that 28% collectibles hit, they are essentially forced to consider asset location strategies, like holding the trust inside a tax-advantaged account like an IRA, assuming their specific strategy and plan rules permit it.
It is a perfect example of how the physical backing is a double-edged sword. It is the ultimate protection against counterparty risk and contango decay, but it exposes you to one of the most punitive capital gains rates in the tax code.
All right, so we have established the macro foundation. We've got the pristine physical moat, the industrial supply crunch, the threat of mean reversion, and the 28% tax burden. Let's look at the immediate timeline. For someone monitoring the markets today, what specific catalysts are in play for early to mid 2026? What is the technical setup signaling over the next 30 days?
Following that recent 3% dip, the chart shows silver currently forming a large range formation.
Break that terminology down for us. A large range formation usually implies the asset is digesting a massive move, bouncing between established support and resistance levels. Is the market just catching its breath, or is this distribution?
The options market suggests it is catching its breath before a volatility expansion. We are tracking a significant increase in options activity around this range. When options volume spikes during a consolidation phase, it generally points to build-in volatility.
So people are placing their bets.
Institutional traders are positioning for a massive directional breakout. The energy is really coiling up. And when you overlay the current macro environment, the bias seems heavily skewed toward hard assets.
The macro forces right now are essentially boxing institutional capital into a corner. We are watching three distinct drivers forcing this sector rotation. First, central bank rate cuts.
Right. When rates drop, the opportunity cost of holding a non-yielding asset like silver drops with it, while simultaneously pressuring fiat currency valuations.
Exactly. Second is the ongoing tariff news. Tariffs are inherently inflationary because they raise the cost of imported goods, and capital traditionally rotates into precious metals to hedge against imported inflation.
The third force is perhaps the most immediate, and that's credit crunch fears. There is a palpable anxiety building in the debt markets right now.
We've been seeing that across the board.
Yes. When institutions fear a tightening of credit conditions, where liquidity dries up and highly leveraged counterparties become solvency risks, they aggressively reduce their exposure to paper derivatives. They seek out assets that are entirely outside the banking system's liability chain.
Which brings the narrative full circle right back to the $23.3 billion of physical silver sitting unencumbered in a vault. But the real wild card here, the catalyst that could turn this large range formation into an explosive upside breakout, is the unconfirmed short squeeze potential.
The data indicates the potential for a squeeze here is considerable.
Given how massive the COMEX paper market is, what are the mechanics if a squeeze actually triggers?
It comes down to the ratio of paper claims to physical ounces. There are massive speculative short positions in the silver futures market. These are funds betting the price will mean revert back to its 5.9% historical trend. But, as we noted at the top of the show, the actual registered physical supplies on the COMEX are rapidly shrinking.
So the physical buffer is gone.
Exactly. If those macro factors, rate cuts, tariffs, and credit fears, push the spot price higher, those short sellers will be forced to buy silver to cover their margin calls.
And because the physical inventory is depleted, their forced buying drives the price up exponentially, which then triggers the next level of margin calls for other short sellers.
It becomes a violent self-feeding loop where the exit door shrinks exactly as everyone is rushing toward it.
And the psychological momentum of the broader precious metals market could be the exact spark that ignites it. We have to discuss the gold spillover effect. Gold and silver trade with a high historical correlation, but silver is highly leveraged to gold's movements.
Very much so. Currently, there is an aggressive speculative target circulating on institutional desks projecting gold to reach $15,000 an ounce by the end of 2026.
Hold on, $15,000 an ounce. I really have to push back on that. That sounds like pure financial fiction. Gold is currently trading nowhere near that stratosphere. What underlying fundamental math could possibly justify a target like that within a single calendar year?
It is an incredibly aggressive, speculative target, and your skepticism is absolutely warranted. A move to $15,000 would require a systemic restructuring of global fiat currencies.
It would be a different world.
However, in financial markets, positioning is often driven by perception. Even if gold only makes a partial run toward that astronomical figure, the psychological momentum will spill over heavily into silver. Because silver has a smaller market cap and higher industrial utility, it traditionally lags gold's initial breakout and then catches up with much higher velocity.
That makes sense.
That kind of broader precious metals momentum would act as a massive structural tailwind for silver straight through the second quarter of 2026.
It is a phenomenal setup to monitor. Let's synthesize this for the listener. The iShares Silver Trust offers a highly liquid 0.50% expense ratio vehicle backed by a pristine $23.3 billion physical foundation. It completely sidesteps the contango decay that destroys synthetic commodity funds.
You have inelastic industrial demand from the solar and EV sectors slowly draining global supply, and the looming very real mechanics of a COMEX short squeeze ready to punish leveraged speculators.
Yet the risks are equally severe. The market is attempting to reconcile a 144% spike against a 5.9% historical growth rate. The threat of a violent mean reversion is real, evidenced by a 52-week trading range that spans $80.
And critically, if you are a retail investor holding this in a standard taxable account, you are staring down a 28% maximum collectible tax rate that fundamentally alters your realized returns. It is a masterclass in why understanding the legal structure of an asset is just as important as understanding its fundamental thesis.
It really is the classic battle between incredible structural momentum and the fundamental laws of financial gravity. We hope this discussion gave you a clearer picture of what is actually driving the price action beneath the headlines, the hidden costs of the tax structure, and the macro forces coiling up for the next major move. Thank you so much for tuning in and spending part of your day with us.
If hard assets are becoming the ultimate lifeboat against credit crunch fears, is the real value of the iShares Silver Trust in its rapid price appreciation, or simply in the fact that it provides a massive $23 billion physical anchor in an increasingly digital and leveraged financial system?
Something to seriously ponder as you watch the charts this week. One last quick reminder, please subscribe and like the show if you found this valuable. It helps us keep bringing you the insights you need. Until next time, stay sharp out there.